Hey guys, welcome back to Solving the Money Problem. Today, we will be talking about the difference between stock and exchange-traded fund (ETF), their advantages and disadvantages, and what are the best possibilities to invest if you are a beginner and trying to make your way through. Without wasting much more time, let's start the fun. What are stocks? First, let's start with what are stocks, so you could have a better idea about this overall topic. The stocks are certificates that show that you hold a fraction of the specific company. How about we make it a bit harder to understand? It's like a form of security certificate that shows the proportionality of a corporation owned by a specific owner, an alias stockholder. Just not confuse stocks with shares. Shares are the scaling unit of stocks. But let's get to dig a little deeper. Types of stocks. Extensively speaking, there are two types of stocks, common and preferred. To make it easier, we could say there are two types of holders, common stockholders and preferred stockholders. Common stockholders are the ones that only have privileges to receive dividends and vote the shareholder meetings, while the preferred stockholders have privileges to receive higher dividends but have a drawback of no voting right. Understanding the concept. Still couldn't make it right? Stock investing for beginners isn't an easy job, but don't worry. We'll make it crystal clear to you. The stocks are offered by corporations to increase their funds, while the stock owner will get to have a quotient of the corporation's earnings and assets. To make it rain, let's consider a corporation with 100 outstanding shares. It is a very low amount and usually has more than 1,000 shares, but hey, let's make the idea clear. In 100 outstanding shares, you buy 20 shares. That means you get to have 20% of the company's earning. It is wrong to say that you own 20% of the company. When you buy a share, you do not own a company asset but get to have earned a profit of the company depending on your percentage and the type of stock bought. So, who owns the company? It will still be owned by its equity owners. I hope I made the overall idea bright and shine. But let's just not get lost in the stocks. Next up comes ETF. What is ETF? ETF stands for Exchange Traded Fund. To understand the concept of ETF, first, you should know what is the mutual fund. For understanding the mutual fund, consider Uber Pool, which is driven by a professional driver, and gives access to anyone who wants to get a ride, meaning who wants to invest. The Uber driver, meaning the professional, buys stocks, bonds, etc. It is good for starters, it is headed by a professional, which is good if you are a beginner and buys stocks, bonds, commodities along many other securities. This means if a stock performs badly, you won't have to lose all of your money but a quotient of it, and you will still be having a part in bonds and other securities. I hope I made the idea of mutual funds crystal clear. Now let's get back to ETF. It is just like mutual funds, but it has an added feature. That feature includes exchange, meaning you can exchange your holdings just like in the case of stocks. While in mutual funds there is no such option of exchanging. That is why it is more suited for beginners, but it has its own drawbacks which we will be discussing later on in the video. Differences between them. Now let's talk about the difference between stocks and ETFs. ETF is like investing in a whole market, while stocks is only about investing in a specific company. ETF gets to have your passive income, while stocks income depends on the dividends the corporation gives you. When a corporation goes down, you lose a huge amount of money, while in the case of ETFs, it is impossible to have the values of different corporations and bonds gotten down at the same time. ETFs cost you a low amount of money as compared to buying individual shares of an individual company. With buying stocks, you will have to take big risks and will put a huge amount of money on the table, while ETFs do not come with a big risk and instead gives you passive income. These were just basic differences between these two platforms. I hope now you have a better understanding of both of those. Stocks pros and cons. The pros and cons of stocks are interrelated. The company that you have invested in may grow its market cap, which will result in building your wealth, but if it goes down, you could lose your money. In simple words, buying stocks is like gambling, so best of luck. The other thing is dividends. It will give you a regular income if the company makes progress, but if it gets affected, your dividend can even be eliminated. If you borrowed money to buy shares and if you are losing, then it will minimize the taxes and you will be able to pay the interest of your borrowed money. But when you are losing the value, it can get really exhausting looking at the stock charts. Investing in stocks is like a roller coaster, with its exhausting and exciting ups and downs. ETFs pros and cons. First, let's start with the pros. You may get stocks or funds from many companies, but you only have to pay for just one brokerage fee. The other benefit is diversification, which is the process of reducing risk and volatility by investing in different assets. ETF provides you the benefits of an investor like a stockholder. You can limit or stop orders and can even sell or buy shares. That was enough of it. Now it's the cons time. If your broker invests overseas, then it will definitely impact your return and you could also suffer from foreign taxes. The other risk is volatility. It may promise you that your investment is immune to volatility, but you may suffer losses at any point. The possibilities to invest. Now that you know all about it, it's time to put your money into it. How to earn from stocks? Let's say as a beginner you want to invest in the stock market and it could be a better idea. as investment in the stock market has been mostly successful than in other platforms throughout the years. The trading of stocks is often done on brokerage companies like NASDAQ or the New York Stock Exchange. Hey, wondering what are brokerage companies? The companies which bring together the corporations and the future stockholders are brokerage or broker companies. These companies charge both of the traders depending on their provided services. When the corporation wants to sell their shares, they contact brokerage companies and they announce these shares through an initial public offering, IPO. The corporation can even sell their shares at a specific and fixed price, or they can sell them through bidding. You can connect with these corporations by creating an account in these brokerage companies. The pricing can be varied greatly depending on the supply and demand, among some other factors. Mistakes you shouldn't make. As a beginner, you should definitely avoid making these mistakes if you want to be successful in the stock market. 1. Impatience. Just keep in mind that earning through the stock market is a long marathon, not a sprint, and that stocks have always risen from the downturns. 2. Neither take a little nor a big risk. As a beginner or a pro, you should never risk too much, cause if you unfortunately lose, then you will be kicked out of the stock market because you won't have a single penny left. Now to talk about the little risk. If you won't take the risk, you won't earn anything. Just try to balance the rod of big risk and no risk. How to earn from ETF? The trading process is somewhat similar to buying stocks. The trading can be done by using brokers online. There are a variety of apps out there which offer ETF services. The best way to start is, so if you are a beginner in the stock market and want to ask which platform should I put my money into? Well, it really depends on personal preferences. If you are eager to take risks and have a good patience tolerance, then you can go for the stocks. If you are the type of person who is looking to grow their money but does not want to take big bets, then ETF is the best choice for you, cause you get to have a passive income. At the end of the video, before investing in any of the platforms, it is important to do your own research and consider your personal circumstances and tolerate your risk level. If you have any questions or have any thoughts regarding this topic, then feel free to mention it in the comments section. If you like our video, then press the thumb and subscribe to my channel for more financial related videos.